Hello, everyone, and welcome to today's webinar where we are going to be looking at the US stock market. And in particular, we're going to focus on one stock today. We're going to do something slightly different to what we normally do in this session. But before all that, can I just thank you for coming along and for taking time out in your busy day to join myself, Anna, and my husband, David. I can see down through the list of attendees, we've got some of our regular visitors. And I know we've got some new visitors as well. So if it's your first time joining us, I hope you enjoy what you will learn in this session. But as always, before we can move over to the charts, can I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading and investing can be a risky business. So please don't ever think of using money that you cannot afford to lose. As always, we will be looking at the charts through the prism of volume price analysis. Just in case you are new and you don't know what volume price analysis is, it's the concept of analysing a chart through the prism of the price action and the volume. This very, very special relationship that these two leading indicators have. Volume price analysis, or VPA as it's sometimes shortened to, is an expression that we actually came up with in 2013. There is volume spread analysis and there is volume and price analysis, but volume price analysis is something that David and we wanted a way of conveying what we were going. Pardon? A catch-all phrase. That's a really good way of describing it, and that's why it's called volume price analysis. And it's sort of been taken up and spread all around the world, really, because I think we are now translated in about 10 different languages. So there's not just the English version. The latest versions that will be going up this year or early part of next year, there's a Spanish version, and there's also a South Korean version. There will be. And a Turkish one as well. There are a lot of Turkish traders who I know use the methodology, and it is a methodology. As I said, it's a price action and volume, but we have also broadened it out to include support and resistance. We use candles and candle patterns. We have since the beginning of our journey into the financial market, going back over 20 years now, and also the concept of time, not just the chart that you trade, but multiple timeframes. And that is something that we are going to be focusing on in this session as well. As you can see, we've now up to 3,463 reviews. The really wonderful thing is that 75% of them are 5-star, which is it's gratifying. But what it also tells me, and I have evidence of this from people who email and also on my X feed, aka used to be Twitter, is that this approach, if you like, to analysing the chart, trying to make sense of the price action that we see, has resonated with so many traders, and not just individual traders, but very, very large groups of traders who have taken the basic concepts and then added their own spin to it, used their own indicators, whether they're proprietary or whether they're standard ones. They maybe have been using a combination of indicators, but what VPA has done, it's kind of taken things back to first principles, and then you can add on your indicators, because once you understand the price cycle, which basically what this book is about, and I have to say, it pays great homage to Richard Wyckoff. I haven't sort of, made this up, as it were, made this up 10 years ago. It is a progression from the work that has been done by the greats of the past, including Richard Wyckoff. And I'd like to think that in the book we do pay, as I said, homage to those great traders and educators. So the other bit of news about the book is that the audiobook version will also be available in the new year. By some quirk of fate, we live very close to a professional recording studio where they are experts in podcasts and audiobooks. They do a lot of audiobook work for the mainstream publishers, and as I said, they're literally sort of 40 minutes from where we live. And I've been talking to their production team, and the audiobook version will be made available in the new year. I have had some feedback on that when I announced it on Twitter. A couple of people said, well, how could, there are charts in there. How can you do an audiobook where you have images? Well, there is a way. You can listen, and the images will be hosted separately, or there will be a PDF available at the same time. Anyway, so that's the news about the book. And when we talk about the analysis on the charts, we are referencing all the concepts that are in the complete guide to volume price analysis. If you've got any questions, please just drop them into the chat box. We'll be more than happy to answer them for you. Okay. A couple of other things that I'd just like to highlight as well before we go over to look at the charts, and in particular Meta. The reason we've chosen Meta is it's obviously one of the Magnificent Seven. I call them the Magnificent Eight, because I've actually also put in Netflix into the group of stocks that are leading the indices at the moment. But before we go, this was actually something that we covered in our Forex webinar, where I suppose Forex traders, they have to pay very close attention to the fundamental releases because the currencies do respond very, very strongly. That doesn't mean to say other asset classes don't. And an economic calendar is very, very important. What I explained this morning, and I'll just cover here very quickly, is that we have economic cycles, we have business cycles, and we have these releases which come onto, which are released every day. As you can see here, you've got retail, you've got the oil inventories, but you've got GDP, etc., etc., etc. And I suppose that one of the differences is a few years ago was certainly before the current market that we have at the moment, a lot of traders didn't really pay a lot of attention to this kind of macro news, as it were. But given what has been going on, certainly with QE and with the Fed and the deficit, et cetera, and obviously with the inflation problems we've got at the moment, they are impacting the markets more and more, certainly on the day trading side. And as you can see from this economic calendar, a lot of the releases are actually come out before the start of the market. So you will get the first reaction in the pre-market. Now, this particular calendar, the reason for choosing this particular calendar is that it covers all those countries. You don't need all those countries. I have Canada up here because this was relating to the dollar CAD pair, so you can take but it's a really fantastic calendar because obviously you have all the releases for the US today, and as we can see here, what have we had? We have had a GDP which has come in better than expected. When you have the bold that we see here, these are releases that are considered to what are called tier one and are considered to have a greater impact on the markets. Now, that may be so, but releases, fundamental data also fit the economic and business cycle. And by that I mean that, first of all, you have to recognize which of these releases the Fed pay the closest attention to. We know they pay attention to the CPI. We know that their preferred inflation metric is the PCE. Now, this has come up today, but it's not bold, and that is because the one that they are more focused on is this one, is the core PCE and what they call personal income. Now, they're focused on that at the moment because inflation is taking center stage. 2 or 3 years ago, there wasn't any inflation to the extent that the Fed or the central banks wanted inflation. They wanted inflation to be 2%. Now, they think we all know what has happened with inflation since then. So their focus is on inflation. So all these releases related to inflation are going to be, they're going to have a bigger impact. They already are impactful, but their impact is going to be even more, as it were. Anything to do with employment, the labour market. 2 or 3 years ago, the labour market was ticking along quite happily. Yes, we have non-farm payroll. Yeah, you'd get the usual reaction, but certainly not the kind of reaction that you have at the moment. So what I'm trying to say is, you read fundamental data in exactly the same way. It's cyclical, and it's where you are in that cycle. Though it's recognizing which of those releases are going to have the biggest impact. Now, the nice thing about this economic calendar is you can also create ones under a category. So this is an all events one, if you like. This is everything, but you can refine it. And I think this is so cool. So if you look at inflation, for example, it brings up the ones that are specifically tied to inflation. As I said, we know inflation is very, very important. And even if you're a day trader, what you have to know is, well, what's coming up? It's part of the kind of background that you can do at the beginning of the trading week, and certainly at the beginning of the trading day. So you know in advance that you know what is going to be coming up. It even goes it goes all the way through into December. And as I said, you've got the bold ones. Looking back to, as I said about the CPI is very important to the Fed at the moment. But there it is. It's all laid out for you on a timetable, so you know what to expect. So you're not going to be surprised when you read on your news feed, oh, the market, reacted, or the market knee-jerk reaction that you get to the market, and because you say, oh, well, what was that all about? Well, at least you will know, and you will know in advance. And of course, you have the interest rates. Interest rates are hugely important at the moment. And yesterday, as you know, if you were trading, if you were watching the markets, we had a nice rally. And it was primarily because, well, first of all, there were three things. First of all, we had the CB consumer conference, a consumer survey. It used to be called the Conference Board, and it's not. People say it's a leading indicator. It's more of a coincident one. It sort of runs parallel, so it carries a lot of weight with the market. Now that came in slightly better than expected, but what really got the market excited yesterday was some comments and speeches from Fed Bowman and Fed Waller, and you'll probably read about it as I said, in your news feed. The market doesn't always react to every comment and speech from different members of the Federal Reserve. They certainly do when Jerome Powell speaks. And this is where, and I've mentioned this before, but I'll just go over it again. It's the ones that they will react the most to. It all depends whether they have a vote when you have the FOMC. If they don't have a vote, they can. I'm not saying they're going to say what they like, but whatever they say, the market says, "Oh yeah, that's awfully interesting." But if you don't get a vote, you're not going to carry a lot of weight in the meetings. But Bowman and Waller certainly do. The other thing to bear in mind is what they say and what the market thinks they say sometimes are two very different things. The third thing you have to bear in mind is every word that they utter is very, very carefully curated. Sometimes they will say things to see how the market will react. So there's this kind of cat and mouse game that's played between members of the Fed and the markets. Now, the question is, well, how do I know are they a voting member or not? And the best place to go is to go over, just if you type into Google Fed hawks and doves, you will come up with, there's a couple of other sites, but this is a really nice site. And it tells you, it was updated on the 5th of October, so I think everyone is up to date, because there have been a couple of empty chairs for regional chairs for a little while. And on the hawk side, and then you've got the dove side. Now, what that basically means, if they're more hawkish, you will find that they really talk tough on inflation. They will do whatever it takes to bring inflation down, even if it means raising interest rates until, maybe, I'm not saying until the economy goes into a recession, but they will really, really push it. They take a much more hard line, if you like, on inflation. The doves, well, I suppose you could say they're more Keynesian, David. They're much more. It's a political thing, if you like, and it goes back to your understanding of how economies work. But anyway, essentially, they divide down. Now, what's happened is you can see here that the whole of the FOMC is very, very skewed to the dovish end of the spectrum. We can see here, and this little symbol here will tell you to the extent to which they are dovish or not. And the way the market reacts is this. So Kashkari, if he makes some comments and statements that basically sit with his view, his dovish position, the market says, yeah, but that's just Kashkari saying what he believes. But if he was to say something that is, that it doesn't, he suddenly makes a very, inverted commas, hawkish statement, then the market will really sit up and pay attention. Now, Bowman and Waller, they sort of sit down here, but the whole narrative at the moment is if and when interest rates will start to fall. The problem with the market has at the moment, and we have, and traders and investors have, is that the Fed members say one thing, but sometimes the market just doesn't believe them, and so whatever they said yesterday, so if they kind of they kind of move away from the agreed narrative, then you get the bigger reaction as well. And of course, you have here who votes and who, most importantly, who will be voting next year. So as we move towards the end of the year, Kashkari, his influence, if you like, on the market, on what he may say, may sort of die down. So that's what I just wanted to highlight for you, because if we go back to the interest rates here, we can see that they do crop up with remarkable regularity. And on some days, as I said yesterday, there was 1, 2, 3, 4, there were 5 of them out on the stump. We've had one today, we've got one on Thursday, and of course you've got Powell at 4 o'clock on Friday. It's obviously the 1st of December, the first day of the last month for trading. So that's what I wanted to present to you, something that you could go away and discover for yourself as well. Right, Meta. Why have we looking at Meta? I've written about Meta on a number of occasions on my Facebook page. I've featured it on my X feed and also on my blog. And it's an extraordinary company. Whatever you think of Mark Zuckerberg and his business model, it is phenomenally successful. And in fact, there's a little story about Mark Zuckerberg. When we had this reversal in fortune for Meta, and we can see here, we had this massive fall all the way down from the high, way down to $85 for the stock. From a VPA perspective, let's talk about the VPA perspective. You can see, if you understand the concepts of VPA, why is that such a significant point on this weekly chart? We can see the fall lower. We can see there's lots of volume coming in there, but given the height of the volume bar and the height of and the range of this candle, when we compare it with this one here, if that was all selling, that would be much bigger. It wasn't. So that was the first signal to tell us that possibly the selling in Meta was coming to a halt. There's certainly stopping volume in there, but this is really the key candle. This candle here, it's a very small compressed down candle with a ton of volume underneath it. Again, if that was all selling, that candle would be much lower. So that was the point that Meta really took off. And as I said, this is the weekly chart, and when we have the volatility candles, that is probably around the earnings. At the time in January, I kind of picked it up there, and then I wrote about it again in January. And I came across an article from a fund manager who was kind of fessed up that he didn't like Zuckerberg. He really didn't like him as a person, and he had allowed his kind of prejudice and his view of the man to. He had missed the first run up. If we go back to right back here, it never got to. So did it get to its low? No, he missed the, if you like, the big move up in Facebook, and he was. I don't even know whether he was actually going to buy some stock, because from a technical perspective, it's a fantastic stock. It also coincided, the reversal in fortunes for Meta, with a statement from Mark Zuckerberg that the company was going to embark on what they call a year of efficiency, David. Year of efficiency, which is basically he was going to cut all the fat from the company, make it leaner, and therefore make it more profitable. And if you have time to go and have a look at the fundamentals for the stock, you will be truly astonished. It's cutting staff, cutting waste is always a great way to increase your bottom line, but he has taken it to possibly another level. And of course, it's not he doesn't make anything. It's not like he's got to make some steel, and he's got to worry about the cost of commodities. This is all online. This is a service company. It's software. So the profit margins are potentially huge. So it's a very solid company, and it's got pots and pots of money. So is he going to be able to withstand any rise in interest rates, which a lot of companies, if they have a lot of debt and going to have to roll over that debt, they are going to suffer if interest rates carry on higher. And I think I looked at their debt, and I think it would take, if they had to settle all their debt, I think it would take them 6 months. Is it 6 months, David, to pay off? So it's a hugely strong and profitable company. Now, this is not a recommendation to go and buy or invest in Meta. I'm just laying out a little bit of the background in terms of the further potential upside to Meta, because it's not at its all-time high, and unlike Apple, say, for example, or even Microsoft, is that it would be certainly looking to regain the 382. Here we are, this candle here, 382 before, as I said, this big sell-off that we have had in the stock. And it's rather nice. We've almost had a V-shaped reversal rally on the stock. Where we are at the moment, looking at it from a VPA perspective, well, we can see the volume has certainly decreased. It is falling. Part of that volume, certainly last week, we've had Thanksgiving, and the markets were closed, and it was only half day on Friday. So you do have to also bear in mind when you see this reduction in volume, and it's certainly approached this resistance here from the outermost band, if you like, created from the volume point of control. But it's still not in consolidations. It's had a little, so far this week, looks like it's had a little bit of a pullback. If we look at the daily, where are we? We've got pretty much the same here. We are at there we are. It's had attempts to move higher. This is last week. We've got a Friday. It moved higher, but the volume was already falling on Wednesday. The day before Thanksgiving, volume does tend to pull back. Traders close out their positions. The volume there was, what was it? It was only 10 or so million. What I also suggest you do is you if Meta or any other company that any stock that you're interested in or company, is always get to know what their average volume is, so that you can look on the day and say, oh, it's done twice its average volume or 3 times its average volume. And then you look at the candle. Has that actually made a difference to the price action? If it hasn't, then that is, it's potentially a red flag. But always bear in mind the context. We're coming up to the holidays. Christmas, not going to be open Christmas Day. There'll be a lot of closing out for the holiday season. A lot of funds close out, whether they close out now, whether they close out in the middle of December. There's a lot of window dressing that's got to be done for the end of the year. So you've got to look at the context. You've got to look at the time of year. And then, of course, we don't have Thursday at all because the market is closed. And then we have Friday. And as I said, Friday there's only half a day. We come back on Monday. We've got a little bit of weakness. Yesterday, what did we have? We had 12, and that's certainly not what you would expect. But as I said, just go and check it out. There are lots of free resources out there. FinViz is one, Bar Chart is another one. Just have a look at what their average volume is on the day. And also bear in mind how the average volume is calculated. Sometimes it's calculated over 90 days. Other times it's calculated over a slightly shorter period of time, so that you're comparing. If you compare two stocks, comparing apples with apples, use the same resource as it were. Right, this is what we've had today. So there we are. What did we have yesterday? We had an up day, not an awful lot of volume. Was there any indication that we were going to have a down day today? And this is where you can look at the faster time frames. We know that it's not in a consolidation, it's not in a tight range, so the chances are we are going to get sort of a trend on the day when a stock or a chart is in a tight consolidation on a slower time frame. If it's a nice wide one, the chances are you could get what's called a good, some two-way tape. Otherwise, but if it's in some kind of trend and it's a strong upwards trend, then the bias is to the long side, and traders will certainly be looking for, if you like, to buy the dip because they believe the rally is going to carry on higher. What I've done on this 5-minute chart is I've done something. Normally I have the extended hours on the chart, but I haven't on this occasion. I've actually put regular market hours because I looked at it and I thought, this is yesterday as we see towards the end of the session. And I appreciate it's the end of the session. So, we do have to be a little bit careful. Did you see that notice come up? You didn't, did you, David? No. Okay. And essentially, the Meta looked to end up quite strongly. Why? Because prices were going up. And if you looked at the volume, it was actually on rising volume. Normally at the end of the session, it's fairly flat, or nothing. You say, oh, it's the end of the session. Everybody packs up and goes home, and you've got the post market, and then whatever goes on in the post market is fine. And I looked at that and I thought, well, that's interesting because it's the end of the session. You've got this really very nice volume and you've got rising prices, but look at the spread. The spreads are narrowing. And I thought, well, I wonder if that's going to have what impact, if any, that's going to have today. And blow me down, here we are. After that run up yesterday, as I said, triggered by the Fed members, suddenly we have everything has tipped over as it were. We have a volatility candle with a reasonable amount of volume. We then have a little up candle, not a lot of volume under it at all, and it actually carries on lower. We do have this attempt to rise here, and I accept we've got a wick to the bottom of the candle. So anyone looking to go long based on yesterday and thinking, oh, I'm buying the dip, if you like, in inverted commas, you would see that, and you would see that volume underneath there, and you think, well, do you know what? That's not a bad possibly a bad place to place a long and a long position, and that would be perfectly reasonable and a rational thing to do. What I've also put on here, which could possibly help, as it were, and that is, this is a Renko chart. This is what we call a time accurate chart and it's only available on TradingView. And what it does, it follows although it's non-time based, we've managed to make it follow the time chart more closely than a normal Renko. And what it does is, first of all, it takes out the noise, and by the noise I mean the wicks and the choppiness and the volatility. And if we looked at it, we could see that it actually flipped over, went a little bit sideways, but stayed red, and then it carried on lower. So ignoring that, if we had this, you could have ignored that, carried on. And at what point do you think that this move lower is possibly going to reverse? Well, the obvious point is if it gets to the volume point of control, because this is it acts as support and resistance. It acts as very strong support and resistance. We actually got through this strong support here. It carried on lower. You have a lot of volume under that candle there, and you think, okay, it's going on lower, but because it's come to VPA is also support and resistance, because it's at the volume point of control, you have to be a little bit patient. You say, well, let's see what happens with the next candle, and in fact, it does. Some buying comes in around the one and it goes sideways. And this is what you would expect when you come to the end of a move, of a trend, a micro trend, just call it a move. The normal reaction after that is you would expect to see stopping volume, you would expect to see some consolidation, some moving sideways, and then you would see the reversal. Now this, I think, and these 3 candles here and this little bit, this is really what I think, and David believes as well, sets VPA apart. Because you see that, you accept that, and you think, right, because you are waiting for the reversal, which you think will come off the volume point of control. You see 3 candles, 3 green candles, but you see the volume falling. And if you only take away one VPA setup signal, it would be this. When you see this reversal, rally, attempt to rally, but it is not supported by volume, and you see it's an anomaly, that should be the biggest red flag, and it's telling you, be patient and wait. This is a trap move. It is most definitely a trap move. It actually runs into this strong resistance. What happens? It goes back to the volume point of control, and then you actually get an acceleration of the selling. You have volume rising, and then what do you get? You get another anomaly. You get this little candle here, very squashed candle. You've also got a pivot. You're at the outer limit of the VPOC. That is the point where if it's going to reverse, it is more likely to reverse. It did reverse here, but we know it wasn't going to carry on higher, and that is where that would be. So if you'd caught that one there, you could have certainly come out at this point. And if you were looking to take the position to the upside, then this is what would have prevented you, because of this relationship between the price action and the volume. And looking at the Renko chart, what we have, it picks up the congestion. And yes, we have the 2 little bricks here, but you always read it in conjunction with the VPA, the price action, the volume, and you think, no, that's not going to happen. And it does carry on lower. And then you know you've got a potential for a reversal. It's really not going very far. This resistance here is really capping any move, but we're still green. we're flat green because we're kind of moving sideways. I'm not sure what the market is going to do for the rest of the day. If you want to look at it multiple time frames, this is the hourly chart. And again, what I've done is I've taken the extended hours on. I've just used the regular hours. This is that big candle down that we have here. A lot of volume underneath it. Then we carry on lower. We can break from the volume point of control here. But look, the volume is falling at the same time. If you read it together, which you should do with multiple time frames, if you can't cope with 3, 4, 5, I mean, David will show you when I pass over to him. He has 6. He can have as many as 6 charts up. At least look at 2 charts. Look at the chart that you're looking to take the trade off, and look at what I call the benchmark chart. And the reason I have a Camarilla on this one is because the levels that are on the Camarilla indicator here, these are valid for the rest of the week. So the levels that are displayed are very, very important. We've got the price levels here from the accumulation and distribution. We've got the volume point of control. And in fact, going back to the 5-minute chart, in fact, let me just pull it this way. It's easier. I move this one out and I move this one out. You can see it a little bit better. Right, where it has actually stopped here, we can see here, it is just above the volume point of control on the hourly chart. Levels on a slower time frame always trump. They always carry more weight. So yes, we had this little reversal. Yes, we had the break higher from the volume point of control. We've then hit this resistance, but it is also coincides with what we have down here on the volume point of control on the hourly chart. And then we have our Camarilla levels as well. And my final thing about Meta, let's just have a look. Where are we here? There we are. Is a quick look at the options market from the perspective of the put and call ratio, and you can see everyone is very positive. If that were anything under 1, it tells us that there are more calls than puts. So the market is certainly the option market is very long at the moment for Meta. Right, that's what I've got to say. I'm just going to pass over to David. And as I said, if you've got any questions on anything I've said, please just put them into the chat box and we're happy to answer them for you.
Hi, everyone, and good to have you with us this evening. Well, it's evening here. I don't know what the time is in your part of the world, but it's early evening here in the UK. So good to have you with us. I'm just going to move the chat box out of the way. I just wanted to have a look at Meta on 2 different platforms. I've got Ninja and I've got TradingView, and also to look at them in the context of the 3 new volume indicators that we've rolled out recently, which is the VWAP, the VRSI, and the MSI, the market strength indicator, the volume weighted average, and the volume strength. Volume relative strength, and they're all volume based. So in addition, they complement the volume point of control, the accumulation distribution, and so on and so forth. So we have a bank, if you like, of volume indicators. Anna mentioned multiple time frames. I tend to have 6, which is what I've got here. They wouldn't necessarily span this particular array of time horizons, because it goes from 1 minute top left right the way down to the daily on the top right. But I just want to have the daily here. We go up to 15-minute and then skip across the daily. But I just want to have the daily here just really for context, because you've seen it on Anna's chart. And it just, when you're trading intraday, it does help to frame what it is you're doing. Am I trading as an intraday trader with the dominant trend? What is the dominant trend for this stock? And by the dominant trend longer term, we're looking at the daily. We might be looking at the hourly if we're really scalping, or the half hour, whatever it is. You have to establish what yours outlined this morning, as I explained this morning. It's very much about, it's it's like you are looking at a monitor screen here of 6 time frames, and really that's how you have to think of it in terms of defining your field of vision, if you will, and the fact that you're not interested in time frames to the downside, and you're not interested in time frames to the upside. Whatever it is you're trying to do, if you're trying to scalp, then at some point you have to have a shutter that comes down and says, okay, I'm trading this intraday. I'm on the, I don't know, 135-minute time horizon, or 123, whatever it may be. And my fastest term or my slowest term of reference is, in that scenario, might be 15 minutes. It might be 30 minutes, just to give me a sense of what is going on longer term. And that's only looking at it in the context of the stock or whatever it is you're trading. In addition to that, and I'll flick over in a moment, you would also look, obviously, what are the primary indices doing? And I've got those set up on the market strength indicator, which not only gives you a view on whether they are all going in the same direction, but it also gives you a view on whether the stock you're trading intraday is also moving in the same direction, or are you trading against the dominant trend for that index or the indices en masse? Is the stock doing something unusual because it's had a good earnings release, or it's had something that is driving it one direction and maybe the indices are going the other direction, or the primary index that stock sits in is going in a completely different direction. So and hence the reason that we have multiple monitors, because to capture all this information and keep a track on all this information, of which volatility is also a key element as well, you're trying to look at all these moving pieces. It's like looking at, I suppose, the inner workings of a watch, where you've got this multiple array of tiny little wheels and mechanisms going on, and you're trying to keep track of what is going on in all the various pieces, whatever context you're doing. And of course, in amongst all that, you've got the options market, which is now so dominating. And probably it is the one aspect of this business of making money, whether you're a trader, whether you're an investor, it is the options market that has really changed beyond all recognition, even in the space of the last 5 years. When Anna and I first started, options was a backwater. It was just, it wasn't even in the sort of mind's eye of most people. Now it is absolutely center front on everything, and I wouldn't say it dictates, but it is getting to a stage where it really does dominate very strongly what is going on in terms of stocks, both intraday and longer term as well. So this is the workspace with the VWAP. Now the VWAPs is a go-to indicator. If you're a stock trader, it is very much the go-to indicator. And what we've done with it is, let's just open one of these up. Let's go to the 5-minute, make it bigger, easier to see. There we go. What we've done, as always, is we've tried to add value to this. And the way we've done that is to combine 5 indicators into one. So if I click on indicators here and go down to the VWAP. I've only got 2 indicators on here. I've just got, as you can see, I've got the VWAP and I've got volume on here as well. But the VWAP itself is, in fact, 5 indicators in one. The VWAP, the traditional VWAP, which you see here, resets at the start of every trading session. And that's the reason up here that you see it really compressed back to 0, because this is the point, excuse me, this is the point at which it starts its calculation for the new session. So every new session starts back at 0 in terms of its calculation. And that's how it's designed to work. Now, on this case, I've got this on the pre-market here. So the physical market is opening here at 2:30. So the VWAP is working in pre-market. And just to change tack for a moment, go on to data series just to show you that as well. I've got the trading hours here set to extended trading hours. You can change that accordingly down the bottom there. I won't go and do it now, but you can have either regular trading hours, or you can go to the extended where you get all the trading per se. So if we go back in here, back to where we were, just down to the VWAP, there we go. As I say, it's 5 indicators in one. Now the traditional VWAP resets at every time the new session starts, so it goes back to 0. That's how it's designed to work. That's how the algorithm works. The second one there, the MVWAP, is the moving volume weighted average. And the difference between that and the first VWAP is that it provides a continuous ribbon of calculation. So where you have this stopping point on the VWAP here and a reset with every new session, with the moving VWAP, it bypasses that completely and it just incorporates the extended trading hours into its calculation. It's a much smoother one. To be honest, it's what I prefer, because what it does is it smooths out the initial candles where you're starting from zero with the traditional VWAP. What the moving VWAP does, as the name suggests, it just moves straight through. It's like a moving average, so it's very smooth. So it gives you a much better perspective, certainly on the pre-market sessions and post, where the price is sitting in relationship to the VWAP and the outer envelopes. So that's the moving VWAP. The AVWAP is the anchored, which allows you to physically pick the starting point that you want. So rather than being tied to a moving VWAP or being tied to a VWAP that starts at the start of the session, you have the option to anchor it where you wish. So it's very much like Fibonacci, for example, where you can pick your spots. So you would pick key points. You'd pick those points which are important, a particular high that is very significant or a significant low, and it will start the calculation from those points. So you have complete control with the anchored VWAP. The time VWAP is the only one that doesn't use volume. It uses time instead, but uses it in a similar way. And finally, we have the intraday, which perhaps not the greatest name we came up with, but what it does is it allows us to put the VWAP onto much slower time frames. So that's the one you would use for investing decisions, for example, where you're looking at the dailies, weeklies, and monthlies, because all of these work on an intraday basis. So those are the five. And in terms of what you see and the way the VWAP is viewed, if you like, it's viewed very much the same as the volume point of control. This central line here, that is the VWAP itself. And then these outer envelopes, the upper envelope and the lower envelope, are one standard deviation, and you can adjust that. I've got this set to 1, which is typically what we use, but you can set it to 1, 1.5, or even 2 if you wish to go that far out. And that really gives you a sense of the fair value, because what traders will look at, certainly in terms of this VWAP line itself, is the price fair value? In other words, is it below that, in which case it would potentially be considered to be underpriced? And if it's above that level and getting up to this sort of region, then it's considered to be potentially overpriced. And that's really the way you view it. And as you can see, what tends to happen, there's two things that really happen which really jump off the chart at you when you're using the indicator. The first one is how the price action really follows these envelopes. It really does tend to mirror them and bounce off them. And it is these extremes that we're always looking for. The VWAP line in the center really presses down. And the second aspect is the number of times that level is revisited. When the price comes back and revisits it, either from the upside or the downside, and then you find it just carries on down. And you've got exactly the same here. The price is reverted, it's come back up, it's revisiting this area again, and it's really struggling to get through there. Now, obviously, the beauty of the indicator is you're not just using it in isolation, you are using it with volume price analysis as well. So you have volume underneath there. So you've got traditional volume relationship down here, and you have the VWAP indicator, which is sitting above. And it is an indicator that is hugely influential for many different reasons, not least because a lot of the institutional orders that are going through the market now are very much based off the VWAP. So that's why it has quite a big influence. I've actually recorded quite a lot of videos, which you'll find on the Quantum site. If you head over there onto the video library for it, this is available on NinjaTrader and it's available on TradingView at the moment, and we will be rolling it out for TradeStation and for MT45 in due course as well. But the videos you can find there at the moment are on NinjaTrader and on TradingView platform. Pretty quiet at the moment, gone into sideways, but as you can see, bouncing off the VWAP here, really not getting through there, and doing pretty much the same thing across the time frames. This is down onto the 15-minute, really moving sideways. And here we are on the daily chart, really up at the extreme. This is our VWAP. This is our outer envelope, the top edge envelope, which is, as I say, 1 standard deviation away from the VWAP. In a congestion phase, possibly building into a 2-bar reversal here on the day. We'll see what that closes at. So potentially, and as I've explained in some of these videos, we don't subscribe to the view that a lot of intraday traders take, which is once the price crosses the VWAP, then that is a signal to either buy or sell. It is too simplistic in our humble opinion. What we look for is we are looking at the extremes here. We're looking at the outer envelopes either to the upside or the downside, but reinforced with volume price analysis below. And that, I guess, is the key difference, because what we're looking for is setups for opportunities for buying or selling, whatever the time frame. Once we get up to these outer levels, the upper or the lower envelopes, as we call them, then we're looking at volume from the volume price analysis perspective. Excuse me one moment. Sorry about that, I had a frog in my throat. And really reinforcing the decision. So it's not a decision which is purely based on one indicator. Nothing ever is. So I reinforce that point, if I may. So that's on the VWAP. Now, if we go over onto TradingView, what I've set up here is the second, which is the market strength indicator. And if you're familiar with the currency strength indicator, which I know some of you are because I can see some names down on the right-hand side that recognize some of our students on the Forex program. If you're familiar with that indicator, then what that shows you is it's showing you several things. First of all, it shows you potential opportunities for overbought and oversold. So if you're looking for an opportunity to get into a stock that's overbought or a stock that's oversold, then you're looking at the outer extremities. So that's certainly one way to view the indicator in the same way that you would a currency strength indicator. The second way of using it is that we are looking for the strength of a trend in the same way we do on the CSI. We're looking for the gradient at which the price is rising. If it's rising at a nice steep gradient like here, then that's a pretty strong indication that we've got a nice strong trend developing. So that is the second way of using the indicator. It doesn't mean that you're trading off extremes. You're maybe going to jump in a trend. Once this starts to rise, you may be happy to jump in the trend. And of course, you're looking at this, we are looking at it in isolation here, but you would be using this alongside the chart. So the charts would be reinforcing this. You'd be looking at volume as well, putting it all together. It's not just looking at one indicator in isolation. The other thing that this indicator also allows us to do, as I have set up here, pull this over a little bit, is I have the 4 primary indices. Meta is the purple line here. So as you can see, we had a little bit of a rollover in Meta here, rolling down. This is on the 3-minute. This is on the 5-minute. And exactly the same way, when you look at trends across time frames, you have to wrap your head around the idea that what you're seeing on a faster time frame, like the 2-minute here on the left-hand side, is a micro element, if you will, of what is happening on a slower time frame. It's like the Russian doll scenario, where you have a tiny little doll in the center, and gradually that you've got more and more and more of them till you arrive at the one on the outside, which is a huge doll. And it's very much the same as this. It's wheels within wheels. So you are constantly dealing with that issue. And it goes back to what I was saying just now about defining your time frame and trying to contain that within a box, if you like, where you're not moving outside that and you're really focused on what is going on in my time horizon. So for someone over here, for example, on this 2-minute time frame, they may well have scalped some dollars out of Meta just reversing down here. For someone looking at this over on a 5-minute, 10-minute, maybe 15-minute, they might be seeing this just as a minor pullback and therefore perhaps something not to be too concerned about. So it depends where you are. It depends where you are in the investing or trading spectrum of what you're trying to do. So what I've got here, as I say, I've got the 4 indices set up. And what that also gives you, it gives you a straight visual on several things. It gives you a visual on whether those indices are all moving in lockstep, which you would hope they would be. We've got the 4 of them. We've got the YM, the NQ, the ES, and Russell. And what you will see on here from time to time, because it's not always the case that all the indices move together. Often they don't. Earlier on, NASDAQ was falling because it was being driven by those stocks in NASDAQ, which are key and major, whereas YM was rising a little bit. So it's not always the case. And often in the last 2, 3, 4 years, we've seen days where one index will be falling quite strongly, another might be in congestion, and the third or fourth might be rising quite strongly. And of course, of these, Russell is certainly the highest risk because you're dealing with companies of much smaller size, and therefore the risk in that index is much greater. And often you will see the Russell diverging from what the 3 sisters, as we call them, are doing. So what I've got set here, I've got the green is the Russell, this I don't know, pinky line here is the NQ, the blue is the YM, I think, yes, and Meta is the purple, and then we've got the ES here, which is the orangey line at the top here. So what it gives you is a very simple visual. And of course, what you can also do with this, I say, of course, what you can do with this indicator is you're not restricted to particular indices. You can go in and add them. So if you go into the settings up here, you can have up to 5 instruments here, and they could be, we could have stocks, we can have indices, we can have commodities, we can have whatever we want. But it's just a really nice, simple way. And of course, it also incorporates volume. So it's looking at the volume price relationship, and it's trying to give us a view on the extent of whether a stock or an index is overbought or oversold. And as I have here, a very simple relationship between those 3 indices. Now, in addition to that, for example, we might want to put the dollar on here. So we put the UUP, we put the dollar ETF on here. So we might have that just to give us a sense of what is going on in terms of the dollar. Or we might have the CSI alongside, again, just to give us a direct view on whether the dollar's rising, falling, and how that is likely to impact equities intraday. So I wanted to just highlight that one for you. Just move those back over there. And over on the other tab here, again, this is Meta. This is a range of time frames. We go from 10 minutes, sorry, I beg pardon, 1 minute, 3 minute, 5 minute, 10 minute, down to the 15, 30, 1 day, and down to the weekly here. And this is with the third of the volume indicators, which is the VRSI, the volume relative strength indicator. Again, I've done an absolute ton of videos of these up on the quantum trading site, so I'm not going to go through it in great detail here. But what I do want to highlight for you really is what the indicator does is it's all about pressure. And if you listen to some of those videos, you'll hear us mention the word or hear me mention the word pressure all the time, because when you're looking at a trend, and this is really a nice example of what we're witnessing right now. When you're looking at a trend, what you want to see associated with that trend is pressure. In other words, has that trend got some real momentum to it? Because if it doesn't have any momentum, then it really isn't going to go very far. And really, that's what the indicator is all about. And it does that really in 2 different ways. It does it in terms of a color change. And you can see it here when we had a lot of volume coming in. And this is the volume relative strength indicator is looking at the relative nature of volume from one bar to another. So if you like, it's taking volume price analysis and peeling back a layer, as I've described it, to really look at the relative nature and to try and give us a perspective on how strong is the pressure that is being supplied for this trend, and therefore do we expect this trend to continue for a while? Because if it has no pressure, and you can view this in very much the same way as we view volume, and that's the beauty of it, because pressure and volume, I guess you could consider them in similar ways. We look at the height of these pressure bars, we look at the relationship, we look at their relationship to the price action, and as you can see here, we had this little rally. And yes, the pressure is diminishing, but we've never really got to a point where we've crossed over into bullish territory. All that's happened is the pressure, the upwards pressure here, we have some upwards momentum, but it's very, very weak. It's declining, and it really hasn't got into positive territory to show us that we're moving into a bullish phase. And all we've done is flatline with these very, very low pressure bars, and we're now starting to it looks as though it's starting to roll over. You can see it here starting to develop over on 3. Perhaps if I pop that one up full size, let's put that one up full size. There we go. And really, that's what's happened. You have this, you can see, let me just pull this up as well, and it'll just give you an idea of the relative nature. There we go. I pull it up to the absolute maximum. This is the sort of pressure that was developed as a result of this price waterfall. And it's self-evident just purely from the height of the bars, irrespective of the color changes where we go from the brighter color to the darker color, which suggests a slight diminishing in that pressure. We see this rally, we see this falling away. But when you see this reversal here, and what's interesting about this particular price waterfall is when you compare it to the pressure associated with this one, it's very, very much weaker. So we don't expect it to go that much further. Just put it right up. There we are. It goes a little way. It's a nice move, but it doesn't have the strength that we have over here. And again, it really comes back to this whole business of comparison and comparative nature of both volume and what we have here, which is pressure with the volume relative strength indicator. And really, this does demonstrate where we move into the upside. Obviously, the fulcrum line here is your crossover point between bullish and bearish. So we've gone from bearish here. We're now moving up into bullish. But look at the height of these bullish bars. They are tiny. And when you look at it in relationship to the height of the selling pressure down here, there's virtually none. It's very, very small. So we don't really expect to see this move develop because it doesn't have that strength of pressure behind it. And now what we're starting, it gets even worse here. It goes almost down to nothing, to a flat line completely. And now we are starting to see maybe a development of a little bit of bearish pressure coming in again, and perhaps a move back down to this sort of level. So that's what the indicator does. I wanted to really just show you that in the context of Meta. And it really brings together the two elements of VPA and this relative nature of volume, which is so important. But the other thing about this indicator, which again, whenever we build these indicators, we try to incorporate other aspects. And the other aspect with this is very much along the same lines as we use with the trend monitor. The trends and the trend monitor was really developed alongside the trends to take a slower perspective on the trend, to try to help to keep you in a trend once it starts to reverse against you, because that is the biggest issue we all face as whether we're traders or investors. When a market starts to slow, a stock starts to slow down, we've got some decent profit in it, then we see a pullback, we panic, we get out, and then the stock continues in the original direction. It happens all the time. The market makers are well aware of that. It's what they do all the time. It is their mechanism of frightening you or getting you to panic, to make an emotional trading decision. And what the indicators we try and develop are there to help you stay in those positions through those trends when you do have these reversals and pullbacks, to try and identify what is genuine and what is not genuine. And to go back to the example that Anna used on her TradingView platform when she was looking at, I think it was the weekly chart for Meta, and you saw that little 3-bar rally, and you saw the little rally, and you saw the volume falling away, that tells you instantly that that is not going very far, because you have an anomaly. You have rising price, but you've got falling volume. So when you combine an indicator like this with our VPA analysis, where that is what we call a secondary trend, and we have tertiary trends as well. But when you've got a secondary trend developing like that against what is the primary, and in that case the primary was lower, and you've got a secondary which is higher, is that secondary a physical reversal? In other words, are we going from primary to primary, or is it simply primary with a secondary pullback and we expect the primary to be re-established? If you can answer that question with any degree of confidence, then that is going to help you hugely to stay in positions and stop you panicking and making that emotional exit position when you're taking your profit off the table, because you've maybe had 2 or 3 losses and finally you've got a winning position and you don't want to lose it. You grab it, you bank it, and you watch, and then you watch in horror as the stock moves off in the same direction, and you realize that what you've witnessed is a secondary pullback against the primary. So it's using all this information in conjunction. It's using indicators like this, the VRSI, using it with VPA to really give you the confidence to stay in. And what I've done on just another workspace very quickly, just to show that in action, I think I've got it up here. Yeah, here we are. Right, this is Meta right now. This is a 1 minute, 3 minute, 5 minute combination. And at the bottom, exactly the same time frame. So 1 minute, 3 minute, 5 minute. And the only difference is I've got VRSI on the top and I've got standard vanilla volume on the bottom. Nothing else. Because what it demonstrates is it demonstrates that relationship, what the VRSI is trying to show you graphically, and you can then reinforce that by what is going on visually below. We've got a bit of an anomaly here. Why is this candle anomalous on the 3 minute? Because the volume here is pretty much the same. We had a widespread down candle. Okay, fine. We can say that's our benchmark candle maybe. What happens on the next one? We've got slightly higher volume, narrower spread, wick to the lower body. We've got the next candle comes along. Again, narrow spread, relatively decent volume, not quite as much as these two, but nevertheless, not far off it. So at the very least, if you're looking at this as an intraday trader, you would be expecting something to happen, at least congestion, possibly a full-blown reversal, but at the very least congestion. And if you're expecting it, then that takes away a lot of the surprise element, the element that says, oh my goodness, what do I do now? Why is this doing this? Why is it reversed? Well, you know why it's reversed, because you've seen it here. It's telling you that you are going to see some reaction because you've got some buying coming in here. This has to be buying. I wouldn't classify it directly as stopping volume, but that's pretty much what it is, because all things being equal, if that's your benchmark candle in this tiny little microcosm of price action, this one should be wider still and down off the page. Well, not quite off the page, but down here somewhere. So it should at least be similar to that one, and it's nowhere near similar to that one. Equally for this one, maybe not as wide as that one, but you expect something, I don't know, around this sort of size, and it isn't. So what's happened? The market's reversed. You're not surprised, you're not horrified, you're not shocked, because it's what you were expecting. And when you look at it over here, we've got a similar sort of picture developing. If you look at the equivalent 3 minute up here, we had some decent pressure coming in here. That pressure has now waned dramatically. We expect to see it because we're seeing it with volume. We're now moving back to the midpoint here of fulcrum, if you like, and then on we go reading our chart. As I said this morning in the Forex session, it's like reading a piece of sheet music. It really, truly is like that. You're reading the notes as the music's like an old pianola, if you've ever seen one of those, where it plays off a roll of paper which has punched holes in it, which play the notes. It's very similar to that, in that you're looking, you're reading at the live edge, and you're incorporating all these elements, and what underpins everything is volume price analysis to give you all those signals that we can then read. I mean, I'm looking at the 1 minute right now. What do we see on the 1 minute? Again, very simple VPA lessons. We got a narrow spread candle here, but the volume is very low. So that you can say is in agreement. It's what we expect to see. Volume and price are in agreement. We've got a narrow spread, but we've got relatively low volume. We then get this candle. Is this anomalous? Yes, of course it is, because we've got a lot of volume gone in there. We've got a little wick, narrow spread candle. So there's a bit of weakness coming in there. Is that enough to drive this market lower? Doesn't look like it at the moment because we've got a wick developing here. But nevertheless, at the very least, you would expect, again, if you saw this on a slower time frame chart, you would expect a pause point. We are on a very fast time frame chart. Up here, you can see the VRSI is holding up here above the fulcrum line. So it's what I was saying earlier on. It's about giving you this confidence. Now that will give you a little bit of confidence to say, okay, it's still saying blue. It's still above the line there. So, okay, I'm not going to be shaken out on that one just yet because it looks as though it might carry on for a little bit. And really, that's what this all comes down to is giving you that confidence to hold a position, whatever it is you're trying to do on an intraday basis or longer term, and not be frightened out on emotional responses. So there we are. I'm going to wrap up there. That's we've covered a lot on Meta there and quite a lot of the indicators as well. Just have a quick look at the questions here. Where are we? Will it be very? Yes, it is. We put these sessions up on YouTube, so you'll probably find them up on YouTube tomorrow. If you head over, if you're not subscribed to Anna's channel, then do subscribe because that will just flag up when the next videos go up. So just on the subscription button, just smash the like button there and subscribe. But yeah, they all go up on the YouTube channel. You may find them in one or two pieces. Sometimes we break them up, but these will be going up full size, I think. How is it possible to have VWAP in the daily chart? The VWAP we have, Leonardo, we've created that VWAP, the one I mentioned, the intraday VWAP, which works over the longer term timeframes and crosses across the sessions. But then that's the same for the moving VWAP as well. The MVWAP, that will also bypass the reset of the VWAP. So it works as a moving average. In fact, if you want to see that in action, we can just hop over there. Nice little rally developing. We've now got to, you can see, we didn't want to be frightened out here, and we weren't. We've held in. It's now coming back. So, we're happy days. We've got rising pressure here. Look at this little rising pressure run up here. So that's nice. That's telling us we've got rising pressure, rising volume. And you see how it relates to volume price analysis in the same way. If we were looking at these as volume bars, we would say, oh yeah, we've got rising volume bars and we've got rising price. Happy days, price and volume in agreement. That's how it all works. So it all fits together. Let me just go back to that workspace with the VWAP, and I'll just very quickly show you that. Where are we down the bottom here? Here we go. Let's just pick one of these, go on to the 5 minute. Okay, just go down to the indicator, onto the VWAP, and we just flick it over onto the MVWAP, and we just apply that. Okay, and now what you see happens is that this is the same period of price action. This is the pre-market. But now what happens is the VWAP moves through that seamlessly, and you can see that across all the time frames. There it is, right the way through. So there is no stop-start. It's a constant flow. It is a constant ribbon. I like it because what it does through these pre-market areas is it gives you a sense of what is going on in the pre-market, whether we are below the VWAP, above the VWAP, and where are we? Because when you reset the VWAP on the traditional VWAP, for the first 5, 6, 7 candles, you really don't get that sense. You're kind of all over the place. So I like using I prefer the MVWAP myself. But we bundled them all together to give our customers, our traders, our students as much opportunity. You decide what you want to use. It's not, you're not investing in one indicator. It's 5 in 1. So you decide which one you prefer. And that's how it works. So there we go. Hope that answers that one. There we go. Thank you so much for coming along today. This evening. Hope you've enjoyed the session. We will be back next week with more. Probably the 2 sessions, the Forex and the stocks on Wednesday, which is kind of our preferred day. So I hope you've enjoyed it. Enjoy the rest of the trading session, and the rest of the trading week. And thank you so much for coming along. We do appreciate it and hope you've enjoyed it. So bye for now.